This is an interesting story from the stock market that highlights the key difference between investors that make millions and those that lose their hard-earned money. Many years ago, I held stocks of a company whose shares then crashed by about 35% due to a specific unpopular event related to the company. The stock had become unpopular, but I resisted the temptation to sell it immediately. It subsequently recovered to its original levels, but it was highly volatile. And so when it dropped about 5% again, I sold all the stocks that I held. Was it a good decision to sell? Now, it's reasonable to assume that the main driver of a return from the company's stock would be its fundamental strength and earnings. This is true, but only in the long term. The stock market can behave like an electoral contest in the short term, where the stock price of a company depends on how popular or unpopular it is at that particular point, including those driven by external events. In the long run, the market tends to act like a weighing machine, where the stock price reflects the fundamental characteristics of a business: earnings growth, financial strength, competitive advantages, and so on. In my case, I knew that the company had solid business fundamentals, but I was worried that the stock was falling despite earnings growth. So I got caught up in the popularity contest, was fearful of the volatility and that the stock would crash heavily again. So I voted in a hurry and sold the stock. I didn't know then what Benjamin Graham had said and what Warren Buffett has reiterated multiple times. In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. Before we look at the key takeaway from my story and what happened to the stock, take a moment to hit the subscribe button for more financial stories and tips. So, after I voted and sold all the stock, it went on to grow 9 times in the next 7 years. The key learning is that you should make buy and sell decisions based on the fundamentals and true value of a stock, and not based on one-off events and popularity contests. Now, this is true in your career and in your life as well. If you focus solely on growth, promotions, money, on being popular and visible, you will see great results initially. But unless your foundations are based on solid fundamental skills and value, like that of a company, you will be found out in the long run and your growth will stop or decline at some point. However, if you focus on building solid fundamental skills and adding value without worrying about short-term ups and downs, you may see flat growth initially, but it will take off in the long run because your skills and the true value you bring will shine through over time. In the case of the stock that I held, I behaved as if it was the last promotion for that stock, and I failed to trust the underlying strength that would bring greater growth in the long term. And if you want to understand the number one strategy that top investors such as Warren Buffett have used to make millions in the stock market, watch this video.